welcome to Merkle Meets and our webinar. So today's webinar has experts from stablecoin policy, product, as well as one of the key law firms in the space, preparing for Genius Act, the practical guidance for compliance, licensing, and operational readiness. That's the topic. So we're still waiting for a few more minutes for Kevin to join us. He's having some technical issues. But meanwhile, we can get the rest of our panelists to introduce themselves. So, all right, great. Kevin's here as well. So, hi, everyone. I'm Mriganka, one of the founders and the CEO of Merkle Science. Kevin, you're right on time. Panelists, would be great to get your introductions and your involvement with stablecoins. So, starting in alphabetical order, Chuk, would you like to go first?
Sure, and thank you for having me here. It's great to be here to talk about such a pressing and topical subject. So I'm Chuk Okpalugo, currently a founder of Stablecoin Blueprint, a advisory media company for stablecoins. Prior to this, I spent many years in fintech and specifically last 4 years building products at Paxos, which is a leading stablecoin issuer and enterprise blockchain provider in the US and globally. So we're excited to dig in here into some of the operational and the products aspects of the Genius Act.
Great. Justin, would you like to go next?
Sure. Yeah, thanks for having me. Hello, everyone. My name's Justin Levine. I'm a senior associate at Davis Polk. It's a law firm. I'm based in New York. I'm in our financial regulatory practice, and I really focus on crypto regulatory matters. I've been working on stablecoin related work since really the ill-fated Libra attempts many years ago. I've been closely following the Genius Act and a lot of prior iterations of these bills, advising both crypto natives, fintechs, and a lot of traditional financial institutions on stablecoins and other crypto regulatory matters. And I have to say, all our clients, not just the crypto natives, not just stablecoin issuers, but all our clients that touch, money, which is, the vast majority, are really interested in stablecoins, not necessarily even if they're going to issue a stablecoin, but how it will feed into their business. So it's really an exciting time. I'm also an advisory board member of Stablecoin Standard, which is a global industry body of stablecoin issuers and other crypto market participants. So really excited to be here today. Thanks.
Great. Thanks for that introduction, Justin. Great to hear your insights, both from an industry perspective as well as with your lawyer hat on. And yeah, last but not the least, Kevin, would be great to get your introduction, and then we can kick things off with the panel.
Hi, everyone. I'm Kevin Wysocki with Anchorage Digital. I'm the head of policy there, so I'm a lobbyist in DC. Worked quite a bit on the Genius Act over the last few years. Very excited that we finally got that across the finish line this summer. It's now law, obviously, where everyone in the industry is really focused on the implementation of that through the rulemaking process. At Anchorage Digital, we're most well known for being custodian, but recently we announced a platform to issue stablecoins from. We already have partnered with Tether and Athena Labs, and we're going to be issuing stablecoins for them that will be Genius compliant later this year.
Yeah, great to have you here, Kevin. So starting off with the first question for our audience there, just a short summary. What is the Genius Act? What are the key provisions and oversight structure that come from it? So we can set the groundwork and build from there. So Kevin, would you like to get started with that answer? And then all the panelists can contribute after that.
You know what? I have heard Justin speak about this before. He is like the absolute best. I'm going to let Justin go first, if that's okay, because I can't do it as well as he can, to be quite honest with you.
Thanks, Kevin. Happy to start, and then you should definitely jump in. So I'll kind of, sure, I'm happy to kind of level set. So the bill, I would say at the highest level, does three core things. The first is it defines what a payment stablecoin is, and then it limits who could issue one in the United States. And I'll get to why that in the United States is really important. So a payment stablecoin, right, is not every type of stablecoin. It's stablecoins that are intended for payment or settlement, where the issuer commits to maintain the peg, maintain 100% reserves, and be able to redeem the stablecoin at par. It doesn't include tokenized deposits, tokenized money market funds, or crypto-backed stablecoins, for example. And then it sets 3 categories of types of entities that can issue payment stablecoins. So that's subsidiaries of insured banks, OCC approved non-banks, and then state regulated issuers that have under 10 billion in outstanding stablecoins. The second thing it does is it mandates full high quality reserves with audits, disclosure, and strict custody rules. The idea there is to create uniformity that any stablecoin that is issued as a payment stablecoin under the Genius Act is fully backed by very high quality liquid reserves. And it's essentially to create standardization for the product, that customers can be comfortable that these things are regulated in the same manner, meant to be highly safe and maintain their par value. And then the third thing it does is, which is what I would say is the meat of the bill, is it establishes a tailored legal regime. And when I say tailored legal regime, what I mean is it's modeled loosely off the bank regulatory regime, but it is by no means, just incorporating bank principles. It's tailored for the particular use cases and design of stablecoins. So a few things it does, it removes stablecoins from the jurisdiction of the securities and commodities laws and puts them under the supervision of banking regulators, both at the federal and state levels. It also designates the issuers as financial institutions, which is a term used under the Bank Secrecy Act, which means that they're subjected to anti-money laundering, countering the financing of terrorism, and sanctions compliance. The bill also, the other kind of key thing I want to kind of level set with is it creates a framework for how foreign issued stablecoins could interact with US platforms. So as I said, you must be registered to issue a payment stablecoin in the US, but the bill doesn't restrict how non-US firms could issue stablecoins abroad. What it does instead is it lays out strict requirements for how they could be listed and traded on US centralized crypto trading platforms. So for a non-US issuer to have their coins listed on a US centralized platform, they'd have to comply with US freezing and seizure orders. They'd have to be subject to regulation under a comparable foreign regime. They'd have to submit to registration with the OCC. That's potentially a pretty big deal. We'll have to see how the rules come in, but that kind of provides an avenue for the OCC to regulate foreign issuers, in some manner similar to the Genius Act. But I think we'll have to see what exactly that prong means in practice. And then the 2 other things are to have sufficient reserves held in US institutions and then not be domiciled in a sanctioned or high-risk jurisdiction. And as I said, those requirements only apply to centralized custodial trading platforms. They wouldn't restrict peer-to-peer transfers or transactions over DEXs. So like a Hong Kong regulated stablecoin, I could still send to Kevin through my MetaMask wallet without being subject to the Genius Act. So I'll say, yeah, that's what the bill does at the highest level. It sets a robust regime. I will say, I think a theme of what you'll hear today is a lot of important details are being pushed to the implementing rules. I think there's, maybe 24 different rules and reports that are required to be issued by the various regulators. It's really the alphabet soup of regulators. So I think a lot of important details are going to be coming down the pike. Treasury has already issued one request for comment and one advance notice for proposed rulemaking. That's kind of like the procedural, minutia that lawyers are interested in. But I think everyone in the industry should be following these things, because I think there's going to be a lot of opportunity to shape what these rules say, and that's just as important as what's in the bill. I think what the rules will do.
Yeah, and one thing I'd add is, beyond the details, and I think Kevin, you're right. That was an excellent summary, Justin. I appreciate that. Is what it unlocks, and so as Justin mentioned, it's really leveling the playing field, legitimizing this new asset, this new form of financial instrument, and enables a clear path for the various different types of institutions that Justin mentioned to participate. And I think the lack of that clarity was holding back a lot of innovation in the space. And so this webinar is part of the process, but it really gives institutions as well as entrepreneurs and other market participants a clear roadmap. The rules and the details obviously are very important, but it kind of at least brings down the solution space to something that's more easily grokked and enables folks like the folks in this webinar and the panel and other folks who I'm sure in the audience to start to prepare for interacting with other stablecoins or even considering issuing your own.
And I think some other important context here is this was a bipartisan bill that passed in Congress that was signed by the president. Over 18 Democratic senators voted for it in the Senate. We had over 70 in the House. That's significant, right? That clarity is going to be lasting as an actual law. It's not merely regulation or maybe some state structures that weren't necessarily built for stablecoins originally. It provides a clear pathway for everyone to participate in the issuance of stable coins, which is very, very bullish, I think, for the future of stable coins. Presents a number of opportunities for investors to really commit capital to this space and see these projects grow into their full potential.
Yeah, thanks for that overview. So Justin, of course, I agree with Kevin as well. That was a great summary, right? A lot of people say the Genius Act is one of the biggest or most critical pieces of law that have been passed for the crypto industry in the US. One of the most controversial parts of this is yield that stablecoins can give out to others that hold the stablecoin. So can the panelists, I guess, starting with Justin, comment on what's permitted under the Genius Act in terms of yield that stablecoin issuers can give out, and what potentially might be the impact of the Genius Act here? Like, what are some workarounds that you'll start seeing in the industry as a consequence of that?
Yeah, so I will say, working on seeing the drafts as they were coming in for the bill and working with clients who were very focused on this language, it was highly negotiated on both sides. It went through many rounds of iterations. I think to start to level set, it would actually be quite helpful for me to just read what the provision says. It's one sentence. It unpacks a lot, though. So it says no permitted payment stablecoin issuer or foreign payment stablecoin issuer shall pay the holder of a payment stablecoin any form of interest or yield, whether in cash, tokens, or other considerations, solely in connection with the holding, use, or retention of such payment stablecoin. So there's several key things there. One is the restriction by the terms of the language in the statute only attaches to the issuer of the payment stablecoin. Two, the other important thing is it prohibits interest or yield. Those terms aren't defined, but I think a lot of people know what those refer to. And then three is that restriction only applies solely in connection with the holding, use, or retention of such payment stablecoin. So I'd love to just hear Chuk and kind of Kevin talk about what they're seeing from an industry perspective. But what I'll say quickly is, does that cover, third-party platforms providing rewards? That's something that's going to be bitterly contested, and it's already being contested among market participants. I'll say, from a strict reading of the statute, it doesn't appear to cover that. But as I said earlier, there's going to be implementing rules. The bill expressly says that the regulators will have anti-evasion authority to issue rules. So, there's some chance regulators try to expand the scope of these restrictions and rules. But at the same time, where the federal courts are in the US right now of taking a very, strict interpretation of laws, I think honing in on that exact language is going to be really important.
Yeah, absolutely. It's a very hot topic for many reasons. And I guess we won't necessarily have time to go into the merits of the arguments on both sides. But looking through the what's live today from major issuers between Tether, Circle, the distributors, the exchanges, Coinbase, for example, it's clear that there's going to be a lot more of a discussion and debate. It's very, very hard for the regulation to distinguish the difference between a distributor paying out revenue versus the yield from the underlying issuer that it is earning from, given the fungibility of money, and particularly the provisions that relate to paying out yield and some of the arguments related to kind of consumer protection, when there's many different ways to reward users or incentivize users that doesn't put their capital at risk and doesn't fall foul of kind of consumer protection concerns. And so I think because of the challenge of trying to prohibit just a rewarding or incentivization of users from different pools of money, I think there's going to be a furious debate, and then also, regardless of what comes out, some very inventive mechanisms of incentives. And so I think where it'll play out, we'll see. The lobbyists are still kind of working on either drafting or redrafting the existing bill or trying to implement new rules. But I think in practice, I think there's a clear kind of market trend towards distributors being able to pay out of their own revenues and using that to incentivize customer acquisition and customer adoption in the same way that credit card issuers would incentivize usage of their financial products.
Yeah, and I'll add, the context here is that a number of the banking trades have sent letters to various policymakers saying that if yield is permitted on stablecoins, then they're going to lose deposits. And the secondary effect of that is they are not going to have as many deposits to then loan out into the economy, and it'll hurt the ability for capital formation and things like that. That's the argument on their side. On the crypto side, I would say that in general, the industry is arguing the bill permits this, and then also it's necessary to encourage adoption, and it's healthy competition in the marketplace between banks on providing basically the risk-free rate, right? Right now, some high-yield savings accounts provide roughly the risk-free rate, and stablecoins would potentially enable that as well to a number of users. I think the one thing, and Chuk touched on this a little bit, I think one thing that's really important in this debate is to protect the ability of the issuers to provide or share some of the revenue with partners, right? There are various partners in this. When you're an issuer, likely you're going to be relying on some kind of bank as a custodian. You may be relying on various technology vendors to provide services. So at a baseline, the thing that needs to be protected is that ability. It shouldn't be conflated with the yield debate. I think on the debate of yield, I wouldn't be shocked if Treasury kind of goes down the middle and says something to the effect that affiliates of the issuer cannot provide yield, but maybe non-affiliated third parties can. I think that might be like a middle ground that still might not be favorable to everyone, but would be a slight change. So I'm really interested to see some of these comment letters that come in on Genius that are due November 4th, and just how the rulemaking process develops over the course of the next roughly year and a half.
So what I hear from that is there will be workarounds based on the language that Justin shared, right? So if an exchange is working with an issuer, there may be a mechanism by which the crypto exchange could potentially reward users holding stablecoins indirectly, as they're not an issuer. I mean, slightly off topic, but one of the major reasons the Genius Act didn't want stablecoin issuers giving yield to holders of the stablecoin was that banks would see less deposits in them. So do you feel that one of the consequences of Genius Act would be that, in essence, stablecoin issuers grow and banks see lesser deposits anyways over time? Would any of the folks from industry like to handle this question first, either Kevin or Chuk?
Sure, I can go first. I actually don't think there'll be a meaningful difference. I remember at my time on Capitol Hill, I remember a lot of bankers saying the ability to lend is most dependent upon the state of the economy. In good times they lend, and bad times they don't lend as much. I also think that there's an opportunity for both to be really successful, and a number of banks are interested in stablecoins themselves. I think we're going to see a number of projects announced. Some already have been on stablecoins. So I think there's an opportunity for everyone here to upgrade our financial infrastructure and to make full use of these payment stablecoins. Obviously, there are tremendous opportunities domestically, right? Whether it's making payments more affordable, instead of paying 2 to 3% at a retailer can probably shrink that down over time to near zero. Remittances obviously are very valuable. I think the World Bank has a report out there that says the transaction costs are about 6%. That could get down to near zero. And then institutions would, I think, very much welcome the ability to use stablecoins to transfer funds around the world. So there are a number of opportunities, whether you're crypto native or a traditional financial institution, and they're both domestic and international. So I think there's a lot of opportunity, and the amount of deposits that banks have won't necessarily go down because of this.
Yeah, and the way I think about this is I kind of break it down into two questions. It's, will the ability to easily earn the risk-free rate impact bank deposits? And then will a decrease in bank deposits lead to negative effects in the economy, such as reduced availability of credit? And you can take those two things separately. Starting with the second, there's a lot of evidence to suggest that, hey, well, look, we've had money market funds that have been available and offering yield. So that's an argument to say that it's not necessarily clear that just offering yield reduces deposits, but sure, money markets are not as easily available as consumer apps. So that's one thing I wanted to keep in mind. And then in addition, when you look at the different forms of lending and the different areas of capital markets, banks only represent a limited portion. For example, in mortgage lending, lots of non-bank lenders who actually represent the majority of new originations. And the split between bank lending and non-bank lending varies depending on the type of loan. But that's to say that a free market can help solve the provision of capital as it already has in the mortgage market. And then secondly, beyond the fact that there's more players who can provide credit, deposits are not the only source of funding for banks. Yes, it's one that if they do have that access, that is, as we know, essentially a regulatory moat, is one that they use, but only represents a small portion for many banks. And so, yes, thinking through the argument on its face, it seems as if this could be a bad thing. But when you break it down, the effects are on the margins, and also the overall benefit for consumers I think we believe that it is improved with more competition for, yes, deposits, but more competition on the lending side as well. And I think you'll see with a more effective, innovative financial system in general, there'll be more innovative provisions of capital and credit to fill the gaps where the banks were not. So I kind of look at it from that perspective, on that argument of whether reduction of deposits will lead to reduction in capital. And then to the first question about whether the deposit will decrease in general, that remains to be seen. You'd imagine that, okay, if there are rate sensitive individuals that are currently holding their balances in deposits with banks, might they switch to a better alternative? At a very high level, you'd imagine yes, and so I think it's something worth looking at. But I think there are lots of other reasons for folks to hold deposits at banks, particularly as a kind of a stopping point for other payments. And the banks and bank accounts today offer more than just holding of your money, including the building of credit, the ability to kind of settle on credit cards, receiving a payroll, and so on. And so you'd imagine over time, as those other aspects of what your bank does for you become served by non-banks, then yes, but I don't think it is solely based on just the rate. I think it's, I can see modern neobanks, including the folks like Chime and others that will pop up in the future, leading to a better service, and that leading to a reduction in deposits. But I don't necessarily think it's purely because of the financial interest. And so something to look out for. But I think, yes, they are at risk, but not necessarily purely based on yield, and not as much as people think.
And I'll just add really quick, to level set on this. The total number of US bank deposits today, I think, is somewhere around 17 trillion. And the total amount of outstanding stable coins is somewhere around like 300 billion. So stable coins today, by my math, that's under 2% of the size of deposits, of bank deposits in the US. So, it's a pretty small share today. Is that going to radically shift, overnight? I don't think so. I think, this just speaks to a broader, the competitive landscape is going to be shifting, and everyone has to think about how they're going to react to that. So as balances shift to stable coins, and as customers want to hold some balance in stable coins, banks are going to react as well, to be there for their customers. I think a lot of banks, even if they don't issue a stable coin, are exploring having in their app or some sort of wallet functionality that they could hold stablecoin balances with a bank. So I don't think they're pure. I think there's a lot of overlap. As Chuk said, there's different use cases. I think it's going to be an interesting Venn diagram of where they intersect. But I also think, it's not just going to be crypto stablecoin issuers versus banks only staying with deposits. I think there's going to be a lot of overlap.
Yeah, and just one thing I'd add there is, you're absolutely right. And it just reminded me of the point that the majority of that 300 billion today is foreign sourced capital. It's not hard to say one-to-one because it's in dollars, but I think it's more equivalent to the $13 trillion euro-dollar market than it is to the 17 trillion of US dollar domestic deposits. Now, over time, with innovation, will we see innovative financial products on domestic soil that supplant not only the domestic bank accounts, but also the domestic fintechs who are also doing a very good job of creating financial services for customers? Potentially. But I think the biggest gap and where folks are seeing adoption is in the use cases of emerging market businesses and consumers who want to hedge their volatile local currency and cross-border payments. And often for that, the capital is coming from abroad.
Excellent answers. I really like the term upgrading the financial infrastructure. And yeah, while stablecoins are top of mind for everyone. It is important to remind everybody that like bank deposits have been around for a while, and it's still much, much larger than stablecoin deposits at this point. I guess one, like a lot of our attendees are compliance officers from the US and across the world. One thing they'd love to know is what are some of the key federal regulators that are given powers and enforcement action in the Genius Act? How do they decide between the options of federal and state as they like if they are a stablecoin issuer, and which route should they pick? So maybe Justin, it'd be great if you can give a summary of the federal regulators that are mentioned, and then each of you could comment about the federal versus state route that's suggested through the Genius Act.
Yeah, so at the federal level, it's essentially the federal banking regulators, the Federal Reserve, OCC, FDIC, and then also the NCUA, which regulates credit unions. The way I think about the federal versus state is there's a 2x2 grid of dimensions to think about this. One is bank versus non-bank, and then as well as the state versus federal. So on the bank side, it's subsidiaries of banks, and their regulator and the regime is dictated by where their bank is chartered. So a subsidiary of a national bank, the national bank is primarily regulated by the OCC. Therefore, the OCC regulates that stablecoin issuer. So the subsidiaries of a bank don't really decide who their regulator is. It will be dictated by already who the bank is regulated by. Where there's more choice is in the non-bank route, where you can choose essentially the federal or state to be primarily federal versus state. There's some overlap. There's some backup enforcement authority that the federal regulators have even over state issuers. But for the state, so I'll say the state non-bank issuers, one important thing to say, as I noted at the outset, it's for issuers that are under 10 billion in outstanding stable coins. The state has to certify as well that their state stablecoin regime is substantially similar to the federal regime created under Genius. And then a new committee established under the bill of Treasury and a few other federal banking regulators have to essentially non-object to that certification. So that's kind of laying it out. I think as a lot of companies are deciding, how to issue and under what structure, there's a few important things. One is federal preemption. So preemption generally is the idea that federal laws can preempt state laws. If you comply with a federal law, you don't have to also comply with overlapping state laws. The bill provides for preemption of licensing requirements for non-banks. And I will say it is considerably clearer and stronger for the federal non-bank issuers. There's some language in the bill for state non-bank issuers, but I think it's a bit less clear and it might not be as strong preemption. Again, this is only preemption for licensing. So for like the main thing is state money transmitter licenses, that a stablecoin issuer would not have to separately get those licenses. The second kind of consideration that I'm seeing clients think about is the supervisory posture of the regulator. Essentially, if you are a non-bank, you go the federal route, the OCC is your regulator. If you go the state route, it's one of, whichever state you select into. I think there's going to be a lot more variation among the states. Some that might be a little more strict, some that will be less strict than the OCC. A lot of these companies already have relationships with state regulators, perhaps if they're regulated as a money transmitter already. So taking into account your current relationship with those state regulators is also an important factor. Where it's going to matter on this dimension is not I don't think as much what the rules say. I think, each state regime will have to be substantially similar to the federal regime. I think, it's going to be like the reserve requirements and such are going to be very, very similar. I think where it might differ is the tone of supervision and enforcement, where you could have some variation. One area in particular, I think, is going to be AML, money laundering and sanctions and other illicit finance compliance. The bill, as I said, says the stablecoin issuers are financial institutions and therefore subject to the BSA, have to have AML and sanctions compliance policies, but it doesn't really say what that means. Like, how do you actually operationalize that in practice? A lot will come in the implementing rules, but in particular, I think, the expectations of the regulator, I think there might be some variation. There might be some variation in enforcement among the OCC versus the states there. And then the last is in speed. One is just for like getting licensed. The states, so the bill is the effective date of the bill is more or less keyed off of the federal regime of those rules coming into place. So I think everyone can assume that no one will be licensed at the federal level until all the rules, most of the rules and the bill is, comes fully into place. The state regime is going to be more up in the air and will vary by states. The states have to, create the regime and essentially certify and go through the process of being deemed substantially similar to the federal regime. I think certain states that have been leaders in stablecoin, stablecoins like New York in particular, will have a regime in place, by day one of the effective date of the bill. But I'm not sure about every other state. Many will, but there's chances that some states aren't fully, established with their regimes by the time the bill becomes effective. So that will surely, impact the calculus of which route you go. And then just the general speed of having applications processed and the ongoing kind of supervision and, presenting things to your regulator, can I do this thing or that, or, those kind of conversations. I think some states will be slower. Perhaps, some states will move quite quickly. But I think that's another area that a lot of my clients have been thinking about. So to summarize, preemption, I think, is stronger at the federal level. The bill seems to have an intent to have it for the state non-banks as well, but I think it's less clear. Supervisory posture and speed and like tone of enforcement, I think there will just be variation among states and then uniformity at the federal level.
I would add, and just to emphasize that $10 billion cap at the state level, that there is an exemption to get, is really important. I think market actors are thinking about that quite a bit, and that's why a number of them have already applied for an OCC charter. Recently, there are at least 15 firms that have. I think some of those are going to be stablecoin issuers. The preemption stuff is definitely a factor. The other thing with some of the federal pathway too is most people don't know this, but national banks can actually already issue stablecoins under interpretive letter 1174. If some of these institutions get that bank charter, they can already begin working with their stablecoin regulator, which will be the OCC, to maybe get a little bit of a head start on being compliant with the Genius Act. Anchorage Digital is a national bank. We've looked at that interpretive letter quite a bit. So I think there's a little bit of an opportunity there as well for folks. The other factor is just reciprocity. Are these states going to get reciprocity in foreign jurisdictions? I think they're going to try to figure that out in the rulemaking process. I don't know how quickly some of these foreign jurisdictions will say that a state issuer that's capped at 10 billion, is going to be able to work across international lines. Maybe they will, maybe they won't. That uncertainty isn't necessarily a good place for those that are thinking about issuing a stable coin.
Yeah, Justin and Kevin nailed it. I don't have much more to add.
Great. I think now moving on to my favorite topic, AML readiness in terms of the Genius Act. So I think, Justin, you already touched upon this a little bit. Stablecoin issuers that are payment-based as per the Genius Act are treated as financial institutions. So what are some AML CFT regulations that they're going to be subject to? How does blockchain analytics play into this? And what are some new challenges that they might see because of the regulation? So yeah, I think that's probably going to be an interesting topic.
Yeah, I think one area in the rulemaking, and as Justin said earlier, Treasury has asked for comments on illicit finance, and there's some questions also related to this question or this issue in the Genius specific comment request from Treasury. But I think one area is like season freeze, and how much does that extend into the secondary market, right? I think a lot of the blockchain analytic firms are thinking about that right now. I think a lot of the issuers are thinking about that right now. And where that line is drawn, it will be very, very important. There's also travel rule considerations, right? We've worked very closely with the OCC to be compliant with that provision for banks. I think that's an open question for a lot of folks in the industry, but there are ways definitely to solve these issues, and there are partners out there for issues to work with. So I think everyone's going to get there, but it's going to take a little bit of time, and it'll be very interesting to see what the rules are and guidance are for Genius.
Yeah, absolutely. I think it is a multi-month, maybe call it multi-quarter, multi-year educational process for financial institutions, even those who are not issuers. For firms who just want to receive, send, and hold and start to interoperate with stablecoins, if you're already a financial institution, then there's a lot of updates that you need to make to your existing compliance and AML processes. And yes, firms like Merkle Science and others who will help with that process, but it is a new muscle to learn. And I think there's not just what you hear and read and learn from the initial kind of integration. There's also a muscle that is built over time. And so I think there's I guess for the compliance folks who are at financial institutions or firms who have those types of tasks and roles, I think it's helpful to kind of start small, where you can then monitor and see where the gaps are based on your initial plan versus reality. There are things that are changing very rapidly, and work closely with your transaction monitoring and kind of the many forensic firms that will help along the way. But there's a muscle that the compliance teams need to build on, how to understand and interpret risk and how to respond to the various different and new risk vectors and surface areas that now exist due to blockchain technology.
I will say one thing that I'm most focused on is seeing how the rules deal with the obligations for stablecoin issuers for primary versus secondary market transactions in their stablecoins. So I think it's clear that, so when I say primary, I mean like when you directly issue a stablecoin to a customer. So I go to a stablecoin issuer, I hand over a dollar, they hand over a stablecoin to me. It's clear that I'm a customer. I have to be KYC'd. I'm subject to, I think it's clear how AML and BSA requirements apply there. And by the way, they already, apply to most stablecoin issuers by virtue of being a money services business and registered with FinCEN. Where I think it's going to be really interesting is what I say is secondary market transactions, which is these downstream transactions. So I get my stablecoin from the issuer, and then I trade it on a DEX, or I just transfer it from my unhosted wallet to someone else, where the issuer, might have no idea where it goes. It's kind of like cash, where I take my cash out of an ATM. I have a relationship with that bank, but then I spend my cash with some third party. The bank has no idea where those dollars are going. There's different trade-offs with stable coins, which is in contrast to cash. My transactions are on a distributed ledger that is public. And the issuer, at least many issuers, have the ability, if they know it goes into the hands of an illicit actor, to seize or freeze that specific stablecoin. You can't, a bank doesn't have some ability to have the cash magically just disappear. The difference, though, is just the scale and, the ease of transacting electronically and natively digitally versus, physical cash. I think, where it's going to come out is the bill already refers to having these abilities to seize and freeze, which I was talking about. I think there's going to be, I think it's going to be clear that when when a stablecoin issuer knows their stablecoin is in the hands of a bad actor, that they seize or freeze those coins. The real $1 million question is what expectations are there to figure that out? So I think, working with blockchain analytics companies is going to be hugely important and paramount. I think, the rule proposals and the requests for comments that are already out by Treasury are asking these exact questions. I think the federal regulators under the prior administration took a categorical view, at least from a banking perspective, that open public blockchains are unsafe and unsound, period, because of this risk I just described of, the pseudonymous nature of blockchains and peer-to-peer transactions, not knowing who your counterparty is, not knowing where a coin has gone, and kind of kept banks out more or less from that framework. Now we have regulators that are, really focused on bringing this within the regulatory perimeter, but are kind of starting behind the 8 ball of how do you do that? Okay, we're going to shift from a categorical no, can't do this, to a risk-based approach. How are we going to set the contours of that risk-based approach? I think it's going to be blockchain analytics and various tools that are available, but the nitty-gritty of how you do that, I think it's going to be really important, and it's kind of unanswered at the moment. But I think the rulemaking will be really important there.
Yeah, I'm excited to see what comes out of that. I think from an issuer perspective, it really depends on the commercial goals and their risk tolerance. And so, like you mentioned, the risk-based framework. But unlike cash, there are these additional tools on these open networks, and so some issuers will take the kind of blacklist approach, where once it's known, that the address is sanctioned or otherwise not suitable, then they can freeze and seize, and then each issuer will have to determine, if not laid out very clearly by these upcoming rules, what that bar is. And so, depending on if you look at Tether versus Circle, they both have slightly different bars for that. You can say, hey, we only respond to law enforcement, or you can say, hey, we actually have our own risk assessment, and we'll do that based on a different categorization. But then you impact the free-flowing nature and openness of the product itself. So it really depends on who you're going after as an issuer. And then the flip side is obviously the whitelist approach, where you KYC everybody and you limit the universe of folks who can use your stablecoin to known actors. And yes, that it can still be in a public blockchain, or maybe you decide to put it on a private blockchain or a public blockchain with private transactions. But then again, it's a different trade-off. You're removing some of the benefits of having an open blockchain and an open network. So I think we'll see a combination. But I think what comes out of the rulemaking will be interesting to set the bar.
All right, yeah. So moving on to our final question for the day before there's audience Q&A. So how do you think the Genius Act will transform the payments and stablecoin industry in the next 5 years? So probably the best question to wrap up the entire panel. So Chuk, would you like to start?
Sure. Yes. bringing legitimacy to stablecoins, I think, is the biggest kind of impact. And the largest financial firms in the world, many of them who are in the US, can now see a new form of innovation for their financial products. And I think the implication is very broad. We mentioned deposits as kind of one aspect that ties into competition with banking, but I think the broader implication is that financial services competition is increasing, and that has benefits for end users, end user retail, and end user businesses, from better, standard financial accounts domestically, but also abroad, faster, cheaper, and more programmable payments, cross-border efficiency. It reduces the amount of, it reduces the effort required to launch new products. And so I think that it's the first kind of starting gun in a decade-long innovation cycle in financial services. We've only talked about stablecoins today, which is really a tokenized form of the dollar, the tokenized forms of other currencies and other assets that will play into this together, where you can get to a place where new forms of financial services, or existing forms but just done in a cheaper and more efficient way, are now possible. So I expect to see new businesses being formed. I think I expect existing businesses who have existing distribution to be able to leverage the distribution to embed financial services. And so expect any kind of large brand, social media companies, other kind of consumer or business applications to say, hey, actually, I'm providing the service to my users, and I can now actually also implement financial services. So it's going to make a huge change to the landscape of how we determine and how we define financial institution. And I think that is a positive thing. So 5 years from now, yes, there'll be many more stablecoins, lots more market cap, but I think the impact on end users is much better financial services, more tailored, and better financial access globally.
Great. Kevin, would you like to go next? I guess from Anchorage's perspective, or just industry standards wise?
Yeah, I think it's the future is very bright. I think the goal of Genius was to create that clarity that industry needed for institutions, to really jump in. I think that's going to benefit the average American in many ways. Obviously, the end user of the stablecoin is going to be able to use these for payments in 5 years. They already can in some applications now. They're going to be able to do that more securely, more affordably. Settlement, which will be much faster, which a lot of actors in this space will really appreciate. The other thing is, I think, for the US as a whole, right? Obviously, the dollar is the world's reserve currency right now. Yes, there are debasement trades going on, but I think what this does is it ensures that for honestly decades to come, that the US dollar will be the fiat currency of choice around the world, and maintain America as the financial center of the world. So I think that's pretty significant. I think what that means is a lot of institutions need to participate in the stablecoin game. They need to figure out what their niche is, and they need to work very hard to upgrade the financial plumbing in our system, to take full advantage of this tremendous opportunity.
Yeah, I think Chuk and Kevin really covered it. All I'll add is, I think, this is a really big deal. I think, like, the last time we had, really important financial law be made was really Dodd-Frank about 15 years ago. Like, that's to say that, like, new financial regulatory laws don't come around very often. And I think putting this in place and the legitimacy that Chuk and Kevin were referring to is really important for, mainstream adoption, and, setting clear rules of the road in statute is really important. The way, how the competitive landscape will unfold, I think, it's going to be really interesting. I don't think anyone can say with certainty how it's going to unfold. My prediction is, you're going to see less. I think there's going to be more stablecoin issuers. I think there's going to be less competition on reserve design. Like, there's really not going to be much competition on reserve design or regulatory status, because that's kind of going to be the baseline under Genius, and it's really going to shift the competition to user experience, payments functionality, integrations, and other things like that, which I think is great. Like, competing on use cases and functionality for your stablecoin, and integration with other kind of services and complementary products is going to be great. And I think it's going to unlock a lot of new use cases. I'm just a lawyer, but I find the arguments of agentic AI and transacting in stablecoins, and, using programmable cash to make those transactions, quite persuasive. And, will it happen tomorrow? No, but down the line, 5 years, maybe. I think all sorts of new use cases can unfold.
Perfect summary, Justin. So yeah, hopefully with the Genius Act, every company may potentially become a stablecoin company in the future. They just don't know it yet. And yeah, upgrading the financial infrastructure, and maybe we'll see some movement in terms of the stablecoin space not being the duopoly that it used to be for the last 5 years. So in the interest of time, moving on to audience questions. Audience, thanks a lot for your time. I know some of you are woken up early in San Francisco, and some of you in Singapore are staying up late for this. Feel free to post your questions, and we'll start going through them sequentially. So the first question's from Richard. There are a lot of investigators who also dialed into this session. So how might the Genius Act affect local economic crime trends, especially in areas with high fraud rates like Florida? Any Florida locals on the panel who'd like to start? Oh yeah, if not, I think anybody could take this question first.
I actually think on like the fraud and national security front, stable coins potentially are an upgrade, right? There's traceability built into a lot of the blockchains. These issuers are going to have to comply with the BSA. So I think I don't know that that's going to be the medium of choice for fraud at scale. So I actually think there could be a vast improvement over time with stable coins, and I think it'll be interesting to see how that all takes off, and if that actually comes to.
I can probably chime in here. So because of what we do at Merkle, we've definitely seen very strong adoption in terms of data of stablecoin adoption globally. The fastest growing segment for stablecoins is criminal activity as well. I mean, despite the fact that it's traceable, the fact that you can move it across borders and its currency doesn't fluctuate makes it popular for criminals. However, I think what Kevin was alluding to was that you can actually see all the transactions. Criminals may get enticed by it and start using it. So while you'll see some of its adoption for economic crime, it'll be a lot faster in terms of tracking the criminal, catching them. And because of freeze functions that most of these issuers would have, also literally seizure of funds would be a lot easier. So, I mean, 5 years from now, you'd probably see lower fraud rates, provided criminals in Florida start using stablecoins, which they might. So moving on to the second question, do panel members see the loose definition of collateral composition in the Genius Act as something that will affect the issuer's tendency for riskier behavior? So 2 points. Since there is no strict definition of what constitutes stablecoin collateral, under regulation may lead to an undercurrent of unauthorized securitizing. The exclusion of stablecoins from deposit guarantee schemes invites more risk-prone management of the underlying capital. So very detailed question from Georgios. Yeah.
Maybe I'll start. So there's a few things I'll say on that. One is, so using stable coins as collateral. Their stable coins are not currently eligible collateral under CFTC derivatives rules for margin requirements and such. But it's actually something just last week, the acting chair of the CFTC, Caroline Pham, issued a statement saying the CFTC is looking to issue rules on that, saying that stablecoins can be eligible collateral and bring it within the regulatory regime. I view that as I view that as like more market structure and secondary market structure and trading oriented. And it doesn't surprise me that that's not dealt with directly in the Genius Act. I think that's more for either market structure legislation, or really, I don't think you even need legislation for that, to talk about collateral rules for using stable coins. That could just be done by the market regulators by rulemaking. The other thing, what the bill does say on collateral is that foreign payment stablecoins, so not ones issued in the US under the bill, but issued foreignly, are not treated as cash or cash equivalents for collateral purposes, for SEC and CFTC derivatives and trading purposes. It doesn't say that they are for payment stablecoins issued in the US. Perhaps the implication is that they are, or it's setting the door for the regulators to say that expressly, as the CFTC might, as even the banking regulators might. But again, that all the bill does directly on that topic is saying that the foreign issues are not. And then the last thing, I wasn't sure if the question was kind of instead talking about reserves of like what's backing the stablecoin. There, the bill is quite clear and quite strict of what are eligible reserves backing a stablecoin. Has to be 100% backed, and it has to be backed by very high quality liquid assets, essentially cash, and very short term treasury securities. So with a maturity of 93 days or less. And then there's repo transactions as well, and there's also SEC regulated funds that hold cash and treasuries, but it's a quite limited universe there. So I think that is something that's directly addressed in the bill.
Yeah, so pretty comprehensive answer, Justin. I think they were referring to the collateral behind the stablecoin, which is already clarified in the Genius Act. The next question, again, the most interesting topic of the Genius Act. So you see affiliate rewards being banned, but not rewards for non-affiliates. What would non-affiliate reward structures look like? How could they potentially, or how would they get that revenue to share? This is a question from Joey.
My understanding on this is that, so if you have a issuer, but that there's a affiliate of the issuer, right? That is maybe an exchange or another entity, they would be potentially prohibited from providing any type of yield or rewards. That is not what's currently the letter of the law. But I'm saying in the rulemaking process, that's a step that may be taken. That's kind of in between maybe where industry generally is and where banks generally are. A complete, like a party that's like a true third party, not affiliated with the issuer, has no like parent company that's similar or anything like that, they may still be able to provide rewards or yield. That was my point when I was saying that earlier. But again, this is something that may be worked out in the rulemaking process, but is not the letter of the law. One last thing, going back to the last question, I know we're over time. On reserves, I think some of the commenters will say, including Anchorage, that there should be diversity of reserves, so there's not concentration risk in any particular type. There could be there, but there's also it's really important that there's adequate liquidity going into weekends and things like that. So I think that's something that Treasury and the other regulators need to think about.
All right, next question from Nikita. So 2 more questions and then we'll wrap up. We're already over time. So thanks panelists and the audience for staying on. So what will happen if the stablecoin stays unregulated at the end of the transitional period? I guess I'd like to add, can a stablecoin stay unregulated, or is it likely it'll stay unregulated at the end of the transitional period? And then will they be mandated to be delisted from US-based crypto exchanges? I think we've seen some instances of this in Europe, where crypto.com and a few other exchanges had delisted stablecoins that didn't adhere to MiCA.
So for stablecoin, upon the effective date of the bill, which is, I think is the earlier of 18 months after enactment, or, sorry, correct me if I'm wrong, I think it's maybe 30 days or some amount of, maybe 120 days after any final rule is issued under the bill. It will be, thanks, it will be illegal to issue a payment stablecoin in the US without being licensed. Essentially, unless you have a pending application, and there's a safe harbor there that I won't go into right now. There's pretty strict penalties for issuing a coin illegally under the bill, and it's like daily penalties. So I think that's addressed by the bill. And then the other element is what I kind of spoke to at the beginning, which is coins issued outside of the US. Issued outside of the US, there's pretty strict criteria, and there were those 5 kind of prongs that I discussed of how those coins could be traded on US centralized trading platforms. If those aren't satisfied, those trading platforms could have a liability. And there's a 3-year kind of implementation date for that aspect. So there's a bit more of a runway, but trading platforms can have liability and penalties if they support tokens, payment stable coins that aren't in compliance with the bill is the direct answer there. You're on mute.
Last question of the day. Again, it reiterates on some of the topics mentioned before, but how does regulatory perspective influence the development of digital currencies in the financial sector after the introduction of the Genius Act? So a question from George. I think panelists, any of you can take this up before we wrap up.
I think the tone in DC has changed substantially over the last few years. Even before Trump was elected, there was much more bipartisan support for crypto. You saw that in some major votes on market structure legislation. I think in terms of like the rulemaking and guidance making process for Genius, you're going to see that play out. I think you're going to have relatively reasonable rules and guidance coming forth on that. And I think that will likely continue in the future too, on rules and guidance coming from regulators, even in future administrations. I think there's more bipartisan support than ever for crypto, and I think that's going to continue to grow.
Right. Yeah. I mean, I guess in short, more adoption or faster adoption across the board in the financial sector after the Genius Act. So with that, thanks a lot, panelists, for your insights. I think it was great, very knowledgeable insights all across the board. And thank you, audience, for staying throughout. And I see we've got a huge turnout and for your participation. With that, we conclude our webinar. Thanks, everyone, for attending and your time. Right.
Thank you.
See you. Bye-bye.